Every month is the same story. You work hard, you clock in the hours, you try your best to make a living. And when your pay slips arrives, the taxman comes from nowhere, dips his hand in your pocket and takes a chunk out of it. Is this fair? It depends on how you see it. And it's not just your income tax. There are several taxes that is against you. The dividend tax, inheritance tax, the VAT, and stamp duty, insurance tax, and several others. In this video, I will walk you through all of them one by one, showing you exactly how much they take, who pays what, and even when you buy something as simple as coffee, who is paying the tax. Welcome to Rich in Progress, where we talk about everything money. We break difficult concepts into smaller bits so that you can use it practically. If you are joining for the first time, welcome to this channel. And if you are coming back again, how are you doing? Thank you very much for joining, and please like, subscribe, and share if you really like what we do on this channel. Okay, so the first tax I'll be talking about is the income tax, which is very familiar with most people because that is the one you always see on your pay slip. The UK runs a progressive tax system, meaning that the more you earn, the higher the percentage you pay on each portion of the income. So the income is always divided into 4 different portions. The first portion is between 0 and 12,571. If you earn less than 12,571, you pay no income tax on it. Okay. The next is the proportion between 12,570 and 50,270. This is called the basic rate. This portion is taxed at 20%. That's the basic rate. The next portion is called the higher rate, meaning that if anybody earns between 50,271 to 125,140, that portion will be taxed at 40%. While the last is called the additional rate, which it is if anybody earns more than 125,140, any portion of their salary that falls above that goes into additional rates, which is taxed at 45%. In addition, if you earn above 100,000, your personal allowance starts to reduce by £1 for every £2 earned, to the point that at about 125,140, you've lost all your personal allowance. What this means is that if you earn above 125,000, you don't get any personal allowance. So no portion of your income will be taxed at 0%. It will start from 20%, then 40%, which is the higher rate, and then 45%, which is the additional rate. Let me give you an example that will kind of make sense. So, Mr. John earns about £35,000 as salary. Okay, how much tax will he pay? First, we'll take the 35,000 and deduct his personal allowance. His personal allowance is 12,570. This portion is tax free. Now, 35,000 subtracted from 12,570 is personal allowance subtracted from 35,000 will give you 22,430. Now, 22,430 will now be taxed at 20%. 20% of that is 4,486. It means that his take home is income tax. There are many other taxes, but his income tax will be £4,486, meaning his take home pay is 30,500, which is not bad. So from 35,000, he's taking home 30,000. Now let's give an example of someone that earns more. John. Now let me say Peter now. So Peter earns 120,000 as his basic salary. So what does that mean? It means that he's going to be charged at the higher rate. His personal allowance is zero. From 0 to 50,270 will be taxed at 20%. That is 10,054, and an additional rate of the rest, 69,730 pounds of his income will be taxed at 40%, which is 27,892. It means that Peter will pay a total tax of 37,946, which effectively is about 31% of his total income, and that's before national insurance, which we'll talk about later. The next form of tax is the National Insurance Contribution Tax, NIC. Okay, and this is a tax that many people forget about. It is a tax that actually still also shows up and comes up from your pay slip. It is a contribution to the state pension and the NHS and benefits and the benefit system, with the hope that if you contribute this national insurance contributions, it is going towards paying you after you retire, or you get to pension age, not when you voluntarily retire, but when you get to pension age, you will be receiving state benefits. Okay, now everyone should be contributing, whether you are employed or you are self-employed. For employees, you pay the national insurance contribution of 8% after your personal income has been taken into consideration, and then 2% above 50,000. Let's give an example of the employee we used earlier who earns about 35,000 pounds. If you want to calculate the national insurance contributions that he will make, what we would do is that from 35,000 we will subtract his personal allowance, which is 12,570. It will give us a sum of 22,430. Now the 22,430 will now be taxed at 8%. At 8%, meaning that this person's national insurance contribution will be 1,794. If we add that to his income tax that we have calculated previously, his take-home pay now becomes 28,700. So what is advertised on the job was 35,000, but his take-home pay is actually 28,700, while he has paid income tax and national contribution of 6,280 pounds. Okay, all this tax really adds up, and that's why you see someone that might be high paying, but really they are paying a lot of tax also. Now, with national insurance contribution, when the employee pays this particular tax, the employer actually pays additional national insurance contribution as a contribution to that person's state pension also. So more so that this the employee is paying, the employer is also paying. This brings us to self-employed people. For self-employed people, they pay two different forms of national insurance contributions. Number one is the class 2, and number 2 is the class 4. This is very, very confusing, but I will try to explain it as best as possible. You pay a class 2. Every self-employed person should always pay a class 2, because the class 2 is about £3.40 per week. £3.40 per week, and it's a flat rate. This is as a subscription. It is a subscription to the state pension, so that you'll be eligible when you get to retirement age. So it's like a pension. It has nothing to do with how much how much profit you make. It's a flat fee of £3, £3 45 per week. Okay, that's the class 2 contributions. It is optional to pay this if you don't earn more than 12,500. So that is your personal allowance. They still encourage you to pay class 2, but you are not required to pay class 4. If you earn above 12,570, more than your personal allowance, if you earn from your business more than your personal allowance, then you are to also pay a class 4 national insurance contribution. The class 4 national insurance contribution is calculated as 9% of all your profits between 12,570, that's your personal allowance, and 50,270, 9% on profits, only profits you made, what you draw down from your company. And anything above 50,270, you pay 2% above that. The next form of tax that people don't realize that they pay every day is VAT, value added tax. Every good and services, except for some essentials like children clothes and most foods, have 0%. However, most other things you buy from the market, I'm talking about shoes, a new phone, a new computer, a microphone like this, or you are going on vacations, or you are renting an hotel, you pay an hidden charge, an hidden tax, which is called value added tax. It's quite different in Canada and America, in North America, because they don't add it on the shelf. So you take a product, maybe a phone that costs 600, that costs maybe like £400, let's say, or £500, something like that, and you take it to the till and you want to pay, but you find out that when you're about to pay, it becomes £600, and you are wondering, they've added VAT. However, in the UK, most goods and services come with VAT, so you do not reckon, you don't know that you're actually paying tax on the goods that you buy, which kind of makes it better in the UK compared to Canada, because now you just know that's the price and that's what it is, but you are actually paying heavy tax on most of the things that you purchase. Next one is the corporation tax, or the business income tax. So if you run a limited company, or you are self-employed, you have your own company where you work, you have to pay something known as a corporation tax. And since April 2023, it is about 25% for profits above 250,000, and 19% for profits under 50,000. So between 50,000 and 250,000, you pay. So for 50,000, under 50,000, profits under 50,000, you pay 25%. You pay 20%, no, 19%. It used to be 20%, 19%, and profit of 250,000, you pay 25%. In between 50,000 and 250,000 it's a tapered increase from 19 to 25. So if you make a profit of, say, about 100,000, which is about in the middle, you'll be paying about 22.5% tax, corporation tax on this. So important thing with people that owns a company or a business, they get taxed twice. Yes, your business is taxed one, and then when you pay yourself, if you pay yourself a salary, you have to pay income tax, and then you have to pay national insurance tax again. However, if you don't use that, and you just pay yourself just your personal allowance, that is, you pay yourself less than 12,570, and then you now take the rest by dividends, then you pay less tax, but there is also a dividend tax, which takes us to the next form of tax, the dividend tax. So the dividend tax are payments from company profits. So people love to use them, as I explained earlier, because you are taxed lower than if you take it as an income, as a salary. So directors often pay themselves in dividends. So in the first £500 of the dividends is always tax free. Then there's a basic rate of 8.75%, and there's a higher rate of 33.75%, and there's an additional rate of 39.5%. So, for example, if you own a company, for example, and it earns 80,000 in profit, you first of all pay 25%, as we said about the corporation tax. You pay 25% corporation tax, which is £20,000. You pay that tax to the government, to HMRC first, and then you have 60,000 left. If you pay yourself 12,570 as salary, meaning that's your personal allowance, you won't pay any tax on that. Then you take the rest of the 60,000 as dividend, so that's 47,000. You take it as dividend. How you calculate the dividend tax on that is that the first £500 is tax free. It's nothing compared to the 47,000, but well, it's okay. So you first of all take the first £500 out. So it means that 46,930 will be taxed at 8.75%, meaning, and that is £4,105. Okay, so it means that you are going to pay a tax of 4,105. However, if you took it as a salary, if you took the whole 60,000 as a salary instead of dividends, then you are going to be taxed at 20% and 40%, so almost 60%, compared to when you are being taxed 8.75% in dividends. So that is why dividends are more popular, but HMRC keeps reducing the allowance. It used to be £5,000 in 2016. I had a company in those days with the dividend that you could take free was £5,000. But imagine, it's been reduced very sharply to 500 £500, which is gutting, to say the least. The next tax to be discussed is CGT, capital gains tax. This applies when you sell an asset that's gone up in value, like a share or a property, crypto, or even a artwork that has just increased in value. You have an exemption, a personal allowance of about £3,000 before every amount above that is now taxed. Recently, the basic rate taxpayer pays 10% for capital gain tax. That's if it's a shares or anything, but it's 18% on residential properties. And if you are a higher or a additional rate taxpayer, you pay 20% for any capital gains. Maybe you sell a share, a cryptocurrency or anything, you pay 20% capital gains tax, and then 24% if it's a residential property, which is quite a lot, to be honest. So what I mean by basic tax payer is anybody that earns below the 50,000 mark. If you earn above 50,000, I think 50,570 or something like that. If you earn more than 50,270, then you are a higher tax rate payer. Usually, when you sell an asset, a share or a property, you don't pay income tax on it. You pay CGT, and this is how this is calculated. The next form of tax is the inheritance tax, or the gift rules. Now, this really is usually emotional because it's like the government is trying to tax the dead. A dead is someone that has worked all his life and has accumulated something and wants to leave it for his children, and then you hit the children with some tax. This is usually quite emotional for a lot of people. The government can take up to 40% of what a deceased person leaves behind. But it's not that easy for them to do it because there are a lot of thresholds that should be met. So, for example, the key threshold is that there is an allowance for someone who wants to leave his asset or his estate for his children. So, for example, if you want to leave your estate for your children and they want to inherit it, it's not going to be taxed. Any amount below 325,000 is not going to be taxed. And in fact, there's an additional 175,000. So if it's one person that is leaving it for their children, there's a 500,000 personal allowance. So if the estate is less than 500,000, it's not going to be taxed. In fact, if it's a couple, that is, the couple are the ones that own the property. So a father and a mother, and the father has died, and then the mother is about to die or dies, and now gives it to their children. Potentially, you will not be taxed until the estate is actually worth more than £1 million. Okay, and it's after £1 million that anything above it will be taxed at 40%. So really, this applies very well to the very wealthy and the very rich. So, for example, if someone leaves a property of £1 million, the children will not need to pay tax. Okay, because the father, if it was a couple that left it, they won't need to pay £1 million. Not many properties are worth 1 million, but going forward, houses prices are increasing and many houses can be more than £1 million. But imagine someone that leaves about £3 million for their children and grandchildren. Then the family will be hit with about £800,000 to pay, because 1 million is their personal allowance, and then 2 million, 40% of 2 million is about 800,000. So this is how inheritance tax can hit hard. And that way that people circumvent this. For example, if someone has a property or an estate that is worth £2 million, you can actually people can actually gift their children the property or the shares or whatever, gift it to their children. And if they live for 7 years after they have gifted it, then that property or that shares becomes free of inheritance tax. So that is another way that people go about the inheritance tax. So they gift it while they are alive, and if they live 7 more years, it's no longer under inheritance tax. Other taxes and hidden charges that you should be aware of beyond this 7 that I have mentioned, which people really know, but there are many more that nibbles at your wallet. The first is the council tax. Local authorities charge based on property value and bands. The average band in the UK is 2D in England, and with this D, it could be up to £2,000 a year. In London, sometimes it can exceed £3,000. You have the excise duties on alcohol, fuel, tobacco. We pay this excise duty on when we buy normal fuel. You have the stamp duty. The stamp duty, whenever you buy any property, you have to pay a stamp duty tax to HMRC, which, to be honest, is really difficult and that's one of the things why it's difficult for people to get on the property ladder, because of this tax. Right now, up to 250,000. If the property is up to 250,000, you pay 0 on it. If it is 250,000 to 925,000, you pay 5% on it. Between 925,000 and 1.5% and 1.5 million is 10%. Above 1.5 million is 12%. There's an additional 3% that is charged on stamp duty if you are buying a second home, which means that buying properties as second home are quite expensive because of this stamp duty tax. You have the very popular vehicle duty tax, which you pay just because you are driving a car, is usually based on carbon dioxide emissions. Electric cars currently are exempt from this road tax, but different cars have the amount of tax that you pay because of the amount of carbon dioxide emissions. You also have the insurance premium tax. Most policies, when you take up any policy like insurance policy on your car, insurance on your home, insurance on your phone, or whatever, there's actually an insurance premium tax that you pay that is actually hidden in the figure that you never know. There's a air passengers duty. It's a tax you pay when you book flights. You would see many times when you see the price of the flight, it might be £600, but when you actually look into the details, you find out that it's actually the cost of the flight itself is £300, but you're actually paying another £325 for the air passenger duty. Another one that is very, very annoying is the TV license fee. It's not really a tax, but in a way you can call it a tax because it's a legal fee that the government lays on every household that is watching any live broadcast, or which is any BBC program. Also, if you haven't watching the BBC iPlayer, not on the television but on your phone or your tablet, you are meant to be paying this TV license also. Everybody gets away with it by just watching Netflix or YouTube and leaving BBC alone to fend for themselves, so they don't get any more of your taxes. And yes, to sum up, the taxman doesn't just visit once. It's not just your income tax. It eats your salary with national insurance. It doubles down on your earnings. It takes the VAT. It takes the corporation tax, the business tax, the capital gains tax. It nibbles around with the dividend tax that your company pays, inheritance tax, taxing the dead himself, local taxes, indirect taxes. And that's why understanding tax is the tax system is the first step to financial clarity. You can't beat what you don't measure. In the next episode, we'll switch from just telling you about tax to tax defense, to exploring different wrappers you can use to exempt yourself from paying too much tax. Drop a comment. Which tax shocked you the most, and which one do you think we should reform? Hit the like, subscribe, and let's keep learning to play this money game together. Let's make it smarter. This is Rich in Progress, where we break every single part of finance and we make it easy for everybody to apply. Thank you very much.